Why Americans are drowning in debt. Comprehensive documentary breakdown, U.S. perspective. America has more wealth than any nation in history. Yet nearly 8 in 10 households owe money. Total household debt has reached an unprecedented $18.8 trillion. At first glance, it sounds impossible. How can the world's largest economy also be drowning in debt? Imagine starting every day already behind. Before you fill your gas tank. Before you buy groceries. Before you pay your mortgage. You already owe someone money. Millions of Americans are living exactly like this. Credit card debt is breaking records. Auto loan payments are rising. Student loans still shape entire careers. And even families earning 6 figures are discovering that a high income no longer guarantees financial security. This isn't just a story about debt. It's a story about how the rules of the American economy quietly changed, and why millions of people are still trying to catch up. Section 1. Most people think debt is a modern problem. Most people think debt is a modern problem. It isn't. America's economy has relied on consumer borrowing for decades. Credit cards became common in the 1970s. Mortgages allowed families to buy homes without paying cash. Car loans made new vehicles affordable. Student loans opened the door to higher education. Businesses expanded using borrowed money. Governments financed infrastructure through debt. Debt itself isn't necessarily bad. Used wisely, it can help people build wealth. The problem begins when debt stops funding future growth and starts paying for everyday survival. That's the shift many Americans are experiencing. Section 2. The cost of living changed faster than income. One of the biggest reasons debt has grown is simple. Life became more expensive. Housing costs increased dramatically. Rent consumes a larger share of income than it did for many previous generations. Healthcare expenses remain high even for insured families. Childcare costs rival college tuition in some areas. Car insurance premiums have risen. Groceries cost noticeably more than they did just a few years ago. Utilities and property taxes continue to climb in many regions. While wages have increased for many workers, purchasing power has often struggled to keep pace with higher living expenses. Many households rely on credit not for luxury purchases, but to cover essential bills. Section 3. Credit cards became the emergency fund. Years ago, emergency savings often covered unexpected expenses. Today, many Americans have limited financial cushions. When a car breaks down, when a medical bill arrives, when rent increases, many families reach for a credit card. The problem isn't always the purchase. It's the interest. If only minimum payments are made, balances can take years to repay, especially with high interest rates. Debt begins growing faster than income. Eventually, monthly payments consume money that could have gone towards savings or investing. The cycle repeats. Section 4. Student loans changed an entire generation. Higher education was once widely viewed as the path to a better life. Many students borrowed with the expectation that future earnings would comfortably repay those loans. For some, that happened. For others, wages didn't rise as expected. Graduates entered expensive housing markets. Many delayed buying homes. Some postponed marriage or starting families. Others balanced student loans alongside credit cards, auto loans, and rent. For millions, debt became a permanent monthly expense rather than a temporary investment. Section 5. The housing crisis. Housing is now one of the largest financial challenges facing many Americans. Home prices increased sharply over the past decade. Higher mortgage rates have raised monthly payments for new buyers. Saving for a down payment has become more difficult while paying higher rent. Many households spend a significant portion of their income on housing. As more income goes toward shelter, less remains for emergencies, retirement, or debt repayment. Housing no longer feels like a stepping stone to wealth for many people. Instead, it has become one of the biggest barriers to financial stability. Section 6. The buy now, pay later culture. Technology has changed borrowing. Today, financing is available almost instantly. Buy now, pay later services allow consumers to split purchases into smaller payments. While convenient, multiple small payment plans can overlap. A household may have car payment, student loans, credit cards, buy now, pay later installment subscription services. Each payment seems manageable on its own. Together they can place significant pressure on monthly budgets. Section 7. The psychology of debt. Debt affects more than bank accounts. Financial stress influences daily life. People may delay medical care. Relationships can suffer under financial pressure. Workers may feel unable to leave jobs they dislike because of monthly obligations. Entrepreneurship becomes riskier when fixed payments are high. Debt doesn't just reduce financial flexibility. It can reduce personal freedom. Section 8. Why high earners still feel broke. One of the biggest surprises in 2026 is that debt isn't limited to low-income households. Many professionals earning six figures also report financial strain. Why? Because expenses often rise alongside income. Larger homes, more expensive cities, childcare, private insurance, higher taxes, lifestyle inflation, large mortgages, student loans from graduate school. Higher incomes can bring greater financial obligations. As a result, impressive salaries don't always translate into financial security. Section 9. The national debt versus household debt. Household debt and government debt are different. The U.S. government finances spending through Treasury securities and has taxation powers that households do not. Families, however, must make monthly payments from their own income. Still, both types of debt influence the broader economy. Higher interest rates can increase borrowing costs. Consumer spending may slow if more income goes toward debt payments. Businesses may become more cautious. Economic growth can be affected. Section 10. Can America break the debt cycle? The future depends on several factors. If inflation continues easing, households may experience some relief. If wages grow faster than prices, purchasing power could improve. Lower interest rates could reduce borrowing costs for some consumers. More affordable housing would help many families build wealth instead of relying on debt. Financial education may also play an important role in helping people manage borrowing and long-term planning. There is no single solution. The challenge reflects years of economic trends rather than one event. Conclusion. America has long used credit to fuel opportunity. For many people, borrowing helped buy homes, start businesses, and earn degrees. But when debt becomes necessary to cover everyday expenses instead of future investments, it changes the financial picture. The question isn't simply whether Americans owe more money. It's why so many households feel they have fewer options despite working hard. The answer lies in the intersection of rising costs, borrowing, income, and expectations. Whether the next decade brings greater financial stability will depend on how families, businesses, and policymakers respond to those challenges. If you're watching on YouTube, please subscribe to the channel and press the notification bell so you never miss our future documentaries on finance, economics, and global events. If you're watching on Facebook, please follow our page and let us know your thoughts in the comments.